Hey everybody, welcome to the video here. I'm going to be covering what limited pay and single premium or single pay whole life insurance policies are. So in these policies, typically in an ordinary whole life policy, or traditional whole life, straight whole life, whatever, when you refer to whole life, people generally buy a policy that they pay on until they reach age 100. So their entire life, per se, right? There are other types of whole life policies called single premium or limited pay whole life policies or single pay. By the way, if you'd like a free study guide, just email me at the email that's right on this video here. You're going to see right there. Just email me just for a free study guide to help you pass your life and health insurance exam on the first try. And there might be a link in the description of the video as well that you can click on to obtain that study guide. So limited pay, we'll talk about limited pay whole life, is instead of paying for their entire life, the insured or the policy owner decides just to pay for the policy for a certain amount of time. So they say, okay, well, I'm going to pay it for 10 years or 15 years or 20 years or 5 years or whatever. Now that they call that, if they pay it in 10 years, it's paid up in 10 years, they call it a 10 pay whole life. If it's paid up in 20 years, they'll call it a 20 pay whole life. Some people will also design them so that they will be paid up by the time they reach a certain age. So 65 is a common one for retirement. So they'll call it life paid up at 65. So it's still a whole life policy, has the exact same features as an ordinary whole life policy, meaning it's got, fixed premiums, cash value, guaranteed death benefit, all that good stuff. But it's just how frequently and what the premiums are changes. So if someone goes for $100,000 ordinary whole life policy and they decide that they want to switch it to a limited pay whole life, say 10 pay, they're going to have to pay up that entire policy in 10 years instead of having it be paid up at age, at a later age. So they'll pay more. Their premiums will be higher, but they'll pay them for a shorter period of time, and they'll actually end up paying in less. So say someone who gets a $100,000 ordinary whole life pays in $60,000 over their lifetime. Say a 40-year-old person gets a 40-year-old male gets a $100,000 ordinary whole life. Say he pays in $60,000 over his lifetime or whatever by the time he reaches age 100. Just hypothetical. I don't know if that's what it would be, but just hypothetical. If he switched to a 10 pay, maybe it would be, $4,000 a year for 10 years. So he'd spend $40,000 on that same policy. He would have spent $60,000 on over the entire life of the policy if he got an ordinary whole life. So all they're doing is compressing the premium payments into a shorter period of time. Now, this lets cash value accumulate faster because the insurance company is getting more money up front so they can cover the expenses of the policy faster. Also, the insurance company is going to make more money off the policy sooner than they will off of someone who pays in for their entire life, because the insurance company takes those premiums and invests them to earn a return. That's how insurance companies make money, right? So if they have more money up front, then they can make more money. So the policy, the cash value ends up growing faster because you're paying more in. And after that 10-year time period, then this guy wouldn't have to pay any more premiums on his policy. So single premium works. It's like the ultimate form of limited pay. You just make one single premium payment, and then the policy is paid up for good. So never have to make another payment on the policy forever. So in that same example, maybe it would be like $30,000 upfront would buy a $100,000 whole life policy for a 40-year-old man. So say 40-year-old man, single premium whole life, $30,000 upfront. If it was a 10 pay, it would be $4,000 a year for 10 years. So like $40,000 total paid in. And if it was, ordinary whole life, say it's, $1,000 a year for 60 years, which is $60,000 over the life of the policy. So as the payment period, the payment frequency shrinks, the size of the premium increases, but the total amount paid in decreases because the insurance company gets more money up front. So that they have cash value. They have all the features of ordinary whole life. The only difference is how frequently the premiums are paid. I hope this helped you guys. If you want that study guide, just email me at the description in the video. I mean, the email right there. It will help you pass your exam on the first try. And email me if you have any other questions as well. Thank you.